I think equities are going to go lower, let's call it over the next 6 months, into the end of the year, into the first quarter. I think we're going to have another hard sell-off. At that point, I think it's very possible that I would want to get bullish on US equities, because I think at that time we may be getting into the whole heart of the milkshake theory, where global capital is flying to the US. Perhaps even the Fed is doing QE at that point. And not only are we, putting the QE that the Fed is providing into the market, but the rest of the world is sending their money to the market, to the US market as well.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part 2 of our interview with portfolio manager and dollar expert Brent Johnson. If you haven't yet watched part 1 of this discussion with Brent, where he provides his latest update on his dollar milkshake theory, which succinctly explains why the US dollar is remaining so strong internationally despite hot inflation at home, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment themes we discuss in this video. Brent also shares his outlook on which assets will perform best through the rough ride he sees ahead for the rest of this year, so be sure to stick around to hear those. All right, let's get started watching part 2 of our interview with Brent Johnson. All right, well, let's get straight to so here we are, middle of 2022. It's been a rough start to the year. We have all the dynamics going on that you listed. Dollar's continuing to be strong. Dollar has now strengthened to a 20-year high. It sounds like you think it's going to stay there. I don't know, maybe it's going to go higher, you think, you tell me. But what is your general outlook for the markets, the financial markets, from your perch right now?
Yeah, so the first half of the year saw asset price and risk assets in general fall and the dollar rise. In the last couple of weeks, we've seen the dollar pull back a little bit, and we've seen a risk-on rally. It would not shock me if we see that risk-on rally last a few more weeks, or even another month or so. And it would not shock me to see the dollar pull back a little more from here. And I cannot tell you how many times over the last year, as the dollar has made a run, that people told me, well, that was it, now it's pulling back. Well, that was it, now it's pulling back. And now it's pulling back again. And I think this is actually kind of a natural time for it to pull back. I mean, it went up a lot in the first half. The ECB, finally said they're going to raise rates. There was a little bit of a change of tone from Powell. So it's, in my mind, it's kind of, nothing ever goes in a straight line. There's always moves and pullbacks and moves and pullbacks. To me, this is that if the dollar is going to pull back, which the world should pray that the dollar pulls back, if this would be a natural time for it to do it. But I think if the dollar pulls back over the next month or so, and risk assets continue to be higher over the next couple of weeks, the next couple of months, I would recommend using that as an opportunity to decrease exposure to risk assets if you didn't do it in the first half of the year. I think that the markets I don't think we've seen the lows. We might have. Again, I don't know for sure. I have a high degree of confidence we're going to see a lot more volatility before the end of the year. Now, perhaps we go higher and then we have a hard pullback, or maybe we pull back here in the next couple of weeks. I don't really know, but what I do know is that there's a lot more risk out there than the last couple of weeks have demonstrated. And I absolutely believe that the dollar is going higher over the next year. Now, does that mean that this whole milkshake theory is going to play out over the next year? I actually don't think it is. I think this is going to play out over a number of years, 2-3 years easily, and maybe 5, 6, 7 years. But again, until the dollar is either artificially written down for good or somehow destroyed, I just think the dollar eventually goes much, much higher.
Dollar going much higher, and looking at the back half of this year, sounds like you're saying, and I know I'm asking you to speculate here, but it sounds like you're saying you don't think this bear market is over yet. That we're probably in sort of a classic bear market rally right now, and that you should use it, if you still have big long positions, as a chance to sell the rally and de-risk out of risk assets. You said the dollar is going to go higher, you think, over the next couple of years. In terms of the markets, what do you think, if you have a little bit of a longer term look on this? Is this a bear market that you think kind of plays out this year, and then we're back to a bull market? Or do you think we're kind of in a different regime now? Over the past 10 years, up until the beginning of this year, the pandemic surprise aside, it was just kind of a constant grind higher, right?
Yeah.
Do you see a return to that, or do you think that we're just in a different era now?
I kind of feel like, for much of like 2017, 2018, even into 2019, I guess at the end of the 2018, we had a lot of volatility. And certainly, in latter half of 2020 and first part of 2021, we had very little volatility. I kind of feel like volatility is back. I don't think we're going to go back to those periods where, volatility is in the mid to low teens and everything just trends up and to the right. I think those times are gone. We're too far down the road. As far as what I forecast out over the next couple of years, to just kind of reiterate my theory, I don't think that everybody should sell everything they own and go to cash. But I think the most important thing is to survive in advance. So I think, everybody should have some cash, whether they live in the US or whether they don't live in the US. And I think that cash should be held in US dollars rather than some foreign currency.
All right. Hey, and I'm sorry to interrupt you, but you're going into my next question. So I'll just let you answer both at once, which is, when we talked earlier in the year or last year, you had said, and this was all pre, Ukraine craziness. You had said that, you were cautious about the markets, and you said there were 4 assets that you really favored and would quote unquote go to war with, and cash was one of them. So you're starting the list. The other 3 were gold, productive land, and blue chip US equities. So could you finish whatever comment you have about cash and then let us know what you think about those other 3?
Yeah, I'll tell you, I'll just say right now, I still agree with that. I think that those 4 assets should make up the majority of your portfolio, right? And perhaps you're maybe a little overweight or underweight one of them, but I think it's important. I have a long-term portfolio, which I don't really mess with too much, because in general, assets go up and to the right over long periods of time. So I don't want to let my short-term beliefs of what the market's going to do overly influence my long-term portfolio that says you want to be in productive assets. But then in my more tactical portfolio and my shorter-term portfolio, I think that I think equities are going to go lower. Let's call it over the next 6 months, into the end of the year, into the first quarter. I think we're going to have another hard sell-off. At that point, I think it's very possible that I would want to get bullish on US equities, because I think at that time we may be getting into the whole heart of the milkshake theory, where global capital is flying to the US. Perhaps even the Fed is doing QE at that point. And not only are we, putting the QE that the Fed is providing into the market, but the rest of the world is sending their money to the market, to the US market as well. But I think at that time, I think that would actually be good for the dollar. I don't think that would necessarily be bad for the dollar. We'll have to wait and see kind of how they do it. But, I think everybody should own gold in their portfolio. I think that's a typical, over long periods of time, gold does well. Gold hasn't done great in US dollar terms for a long time, but, it's done great in yen terms. It's done pretty good in euro terms. It's done great in other currency terms. And I think I don't think you're going to lose a lot by having gold in your portfolio. And then, what I do with the shorter term buckets, I do a number of speculative short-term trades, and some of those are very high risk, very high reward. Some of them maybe we hold for a couple of weeks, but long story short, I do think that we're going to have volatility in the equity markets and global risk assets over the next 6 months. And then after that, I'll just have to reassess.
All right, great. A couple quick clarifying answers on this, then we'll start wrapping things up.
Yep.
Well, let's start with gold first. So you said it's done great in other currencies besides the dollar, but it's been disappointing for dollar holders that have been owning gold. A lot of people scratch their head and say, why? Like we finally got the inflation that we thought was coming, and we owned the gold beforehand, and it really disappointed. So can you demystify for folks why gold's been disappointing in US dollars?
Yeah, I think so. And I hesitate to say this, but I'm going to say it anyway, because I always kind of get hate mail whenever I say this. But I think it's very, very important for gold proponents or people that have owned gold, or that have owned gold, or they're planning to own gold, to keep a level head about gold. I'm actually a huge advocate for gold. I think everybody should own it in their portfolio. But the simple truth is that over the last 10 years, gold did not help you very much if you're a US dollar investor. Now, in other currencies, it did well, but over the last 10 years, it did not. And if you look at gold miners, if you look at the GDX ETF and you look at the GDXJ ETF, and if you look at the Barron's Gold or the Philadelphia Gold Mining Index that goes back to so GDX goes back about 10 years. GDXJ goes back, I think, 15 years. And the Philadelphia Gold Miners Index goes back, I think, 40 years. Since inception, all of those indexes are down. Down. Not positive at all. They're down. And that's not to say that you shouldn't own gold miners. It's not to say that they can't provide an incredible amount of value. The point I'm making is don't be so certain and put all of your money in that, because it might not happen right away. So I continue to believe that everybody should have gold in their portfolio. I do not think it should be, your whole portfolio. To me, I'm comfortable having up to 25% in gold, depending on someone's personal situation. But I don't think that should be the only asset. And in most cases, it probably should not be 25%. But I do think it's very important to own gold. If you are not a US dollar denominated investor, then I think it's even more important to own gold. If you are a US dollar investor, I think you own gold, and think of it as an insurance policy. Don't think of it as your get rich quick scheme. The reason that gold hasn't done well, in my opinion, is it hasn't had to do well. In other words, whenever a currency comes into crisis, gold does very well in that currency. But you know what? Despite all the protestations, the US dollar has not come into crisis in the last 15 years. It just hasn't. Now you can say that it will, but it just hasn't yet. And so as a result, it hasn't had to do well. But I would say that if the dollar comes into crisis, or if the dollar dramatically loses value, I think gold will do very, very well. And when that time comes, you'll be glad that you have some gold.
Okay. I got to parse this now, because you just spent the whole interview telling us why the dollar is going to strengthen from here, you believe, but yet you still own a whole bunch of gold. So is it that you believe there's a dollar crisis somewhere in the future, or?
Well, I think so. It kind of goes back to the point you made earlier. It's possible that all fiat currencies lose value, even though the dollar is rising versus other fiat currencies. That is possible. I will not deny that that is possible. And it's part of my thesis is that we will get into a period where the US dollar and gold will rise together versus all other currencies and against many other assets. We're just not there yet.
All right. And that was my next question. So what leads you to think that they both will?
Well, because I think, again, there's this idea that you cannot have a rising dollar and inflation together. It's completely wrong. Of course you can have inflation and a rising dollar, or maybe I should say a rising DXY, right? The dollar index can absolutely go higher and have inflation in the United States. That can absolutely happen. If you doubt that this is possible, then ask yourself if your cost of living is higher today than it was 15 years ago. And if your cost of living is higher today than it was 15 years ago, and then you go look at the DXY index from 15 years ago and you realize the DXY is up 20% or more, then now you had a rising DXY and inflationary pressures, right? So it can absolutely happen. And I think as we get further into this crisis, I don't think people will put all of their money into the dollar. I just think the money that, I think they'll put a lot of it in the dollar, but they'll probably start putting money into gold as well, right? And if we get into a sovereign debt crisis where, government bonds are being, rejected and nobody wants to buy government bonds, well, then that's going to open up new assets to receive those flows. I think US equities would be one of them, but I think gold would be one of them as well.
All right. No, that's actually a great answer.
I want to make it clear. I'm a big proponent of gold. I think it could do very, very well in the years ahead. I'm just saying, don't go all in on it.
Got it. There's a topic I'd love to explore with you. We'll have to do it next time just for time reasons. But sort of before bond yields started rising, so earlier this year, a question that was getting increasingly answered, which is, hey, you've got this massive bond part of your portfolio, if you're an institutional money manager, that's giving you a negative yield. In fact, it's probably still giving you a negative yield at today's inflation rates. And so sort of painted as the conundrum of the bond portfolio manager, like, what do you do with that money? And increasingly we're hearing voices saying that, well, gold starts looking a lot more attractive in that world. Do you sort of see a similar potential migration of at least some bond capital into precious metals for that reason?
Yeah, I do. And what I would say is I would expect that those flows to come from foreign bonds before they come from US bonds. I think they could come from US bonds as well, but I think that I don't think we're going to get into a situation where US bonds are being rejected and the rest of the world bonds are being purchased. I just don't believe that that's going to happen.
Yeah. Well, certainly right now where the interest rates on most ex-US bonds are much more deeply negative real yields than US bonds. All right. Well, look, so in wrapping this up, two last quick questions. One is, you sort of said with equities, you sort of expect that they're going to go lower in the near term, let's say, 6-ish months or so, but at some point you think they will bottom out and you'll use that as an opportunity to start buying, high quality companies at good value. I'm just curious, are there any particular sectors or companies that right now that you would like to purchase, in that scenario, or is it really going to depend on the details of what's happening, boots on the ground details at that time?
So I don't consider myself a stock picker, but in general, I would favor big, large US blue chips. And I'm going to say a few names of few stocks. This is not a recommendation for these stocks, but I would just say stocks similar to these. Something like Coca-Cola, right? It's a huge US blue chip battleship company that pays a nice dividend. Something like Philip Morris, which is for the most part recession proof and pays a very nice dividend. Something like Lockheed Martin, which is a government defense contractor and is probably going to continue to have government contracts for the foreseeable future and pays a nice dividend, right? Anything kind of agricultural related, because I think that is going to be, an area of growth. Something that's energy related, maybe the big oil producers or whoever it is, and then that pays a nice dividend. Those are the types of companies that I would be looking to allocate capital to.
All right, great. Well, as we wrap up here, Brent, any last parting bits of advice for the regular investor who's just looking to kind of, prudently protect and grow their wealth through this, what you've said is likely to be an increasingly volatile time going forward?
I think what I would say is that, in my opinion, a little bit of knowledge is one of the most dangerous things in the world, because you learn something new and now all of a sudden you think you know everything, and you go and you put your whole portfolio on this new idea that you discovered. And I would say, don't do that. You don't need to go, I can think of very few reasons you should ever go all in on something. A 10% position in a portfolio is an absolutely enormous position. Most professional money managers don't have more than 4 or 5% in one single position. And in many of them would consider that a big position. So, keep a level head, don't go all in on everything. And anytime you get certain about something, you should check yourself, because there is no certainties. So keep an open mind. If somebody says something that you think is unlikely, it's fine to think it's unlikely, but you should probably at least consider how that could possibly happen.
All right, very well said, and very complimentary to what Thomas Thornton just said in my interview with him yesterday, where he said position sizing, that's what he attributes hands down to his success as a portfolio manager. And he says he never lets a position get above 5%. Yeah. All right. And I think you also just made, as usual, Brent, we're going to have our the financial advisors that come on this program. We're going to do a little deconstruction of what the markets have done over the past week in just a minute here. But I think you just gave a great reminder of why most people should seek the counsel of a professional financial advisor who gets these macro issues you're talking about here, to help them with the discipline of A, coming up with a plan, and then B, sticking to it and executing on it and not letting emotions kind of whipsaw. So anyways, I see you nodding as I'm saying all this. All right, Brent, well, look, for folks that have really enjoyed this conversation, especially those that hadn't known of you beforehand, where should they go to follow you and your work?
Well, the place I'm most active is on Twitter. If you search Santiago Capital on Twitter, you'll find me. The logo is a black background with a white seashell on it. I have a video on my pinned tweet that kind of summarizes a lot of what we spoke about here today. That's about 5 minutes long and does a good job for people who have never heard of it before, getting another summary of it. I'm very active on a number of podcasts and stuff. So if you go to Google or YouTube and type in Brent Johnson or Santiago Capital, you'll get a number of links. And I think I think you have a number of them on your website as well. So there's been videos in the past that people could reference.
All right, fantastic. And Brent, when we edit this, we'll put up the links to your Twitter handle and your what to Google and all that stuff. But anyways, Brent, it is always a joy having you on here. Another phenomenal discussion. Look forward to having you back on the program later on to kind of do an audible call as to where things are a couple quarters down the road here. But really appreciate your time today, and thanks so much again.
Great, thanks for having me.
All right, well, now's the time on the program where we bring in the lead partners from New Harbor Financial, one of the financial advisory firms officially endorsed by Wealthion. Today, I am joined by Mike Preston. His partner, John Lodra, has the day off. Mike, great to see you. Let's dive right in here. Another great discussion with Brent. I assume that there's probably a lot of like-mindedness going on between what Brent shared and how you guys think, but let me know your actions. So what did you think of what Brent said in this interview?
Hey, Adam, good to see you again. I really like Brent Johnson and his viewpoints, his writings. I really enjoyed that talk. I've got 2 full pages of notes here. Yeah, I think that Brent really explains this theory very well in just common terms. He talks about, the landowner, I don't know where it was, maybe in Texas or something, that says, I don't need to have oil. I'll just put my straw over there and drink your oil. I guess it's true. I mean, we have the ability in the United States to basically drink from the global liquidity, and all of that liquidity is very tightly hinged to the U.S. dollar. And I just thought it was pretty fascinating. It really explains why, after all of these years of printing money and just seeing the money supply go up and up and up, while the velocity has collapsed, that the dollar is still 25% higher than it was in 2008 during the great financial crisis. That doesn't mean that long-term the dollar doesn't have some risk. I think the dollar is at risk long-term. And then Brent points out what I really do believe to be the truth, and it's a really kind of difficult thing to think about. And the truth is that no nation has ever lost the world's reserve currency without going to war over it, and so he says there's only a couple ways that the dollar would lose world reserve currency status. One would be if we lose a war, or 2, if we agree to some kind of global central bank digital currency. So I really tend to agree with that. So there's just so many moving parts to all of this and what it means to our markets. And I think that nobody really can tell what the immediate future will bring. Brent says that he thinks the next 6 months or so, equities will be weak. We really do agree with that. We're having a huge counter trend bounce here. Still, as we speak on August 3rd, the market is up. The S&P is down only 13.7% from its all-time high now. We've had a really big bounce the last few weeks. In the volatility, the VIX has fallen substantially from close to 40 to around 21 at the moment. So we agree with Brent that equities are likely to be weak in the near term. I'm not sure if we completely agree that we want to be in high quality equities that soon to buy the dip, so to speak, because he says that there'll be lots of good valuations. We'll probably also selectively pick and buy equities in certain sectors. The sectors that we like are the ones that we talk about all the time: raw materials, precious metals, commodities, basically things that come out of the ground or grow on the ground. So all in all, I think it was really good. I know we'll dive more into the details in this conversation, but that's just a quick recap of how I saw it.
All right. Yeah, I agree too that Brent is really good at explaining something that I think is very counterintuitive to people, but explaining in an easy to understand way. For me, one of the things that was helpful was, I've talked with Brent a couple of times, and I always kind of get a new way to look at the situation each time we talk. And this time the light bulb that went off in my head was sort of that relative sizing of the U.S. domestic currency supply. I call that the pebble. And then you have the Eurodollar market out there, which I call the boulder, right? And at least that helps me sort of think about how we can dramatically increase the size of the pebble. We can maybe double it, right? Increases by 100%, but that can be completely offset on a global level if the size of the boulder shrinks maybe even by just 5 or 10%, given their relative differences. And
I think that was brilliant, Adam. By the way, I just wanted to say I think it was brilliant. The pebble in the boulder. You had Jeff Snyder on a few weeks ago talking about the Eurodollar, and he's brilliant. But I think that I still didn't completely. There's parts of it that didn't come through to even me and a lot of your viewers. And I think that analogy was excellent that you did.
Well, thanks. I do a lot of metaphors. It's nice to know at least one of them recently has hit. But that's, again, the regular people, understandably, this stuff takes a while to really understand. And so regular people have a hard time intuitively thinking like, well, okay, so how come we've got super hot inflation at home, and that means the dollar is losing purchasing power, but how come it's the strongest it's been in 20 years, right? Well, Brent's model actually has a lot of explanatory element on that. And I think it also has a lot of explanatory power in terms of just where capital is flowing these days and why, right? So we're all about trying to figure out where the puck is going here. And for me, the dollar milkshake theory has been one of, if not the most useful explanatory frameworks that has explained what's been going on so far in 2022. Now, what's interesting about that is Brent has his assets that he'd go to war with, right? Cash, right, which has done very well this year. Productive farmland. We didn't get a chance to talk too much about him on that, although I know that that's something that you guys help people, decide if they want to invest in that or not.
We do.
Then he's got blue chip U.S. equities, which we'll talk a little bit about more in a moment. But what I heard from him, which I think was similar to you, is hey, this bear market's got further to go. This isn't necessarily a time to go whole hog in those companies, but it's the time to start pulling your shopping list together so that if the bear market does flush out, then you can start buying those great companies at better values. And then gold was the fourth. And, gold, we talked about how it sort of disappointed people so far, and it has, based upon how people thought it would react, how Americans thought it would react, given the hot inflation here in the US. It's done great in other currencies. But, it hasn't lost that much value this year. So you can say it actually has done its job as sort of a, going back to, who was talking about this last week? Louis Gove. It's your defensive lineman, right? He's not going to score touchdowns necessarily, but you count on him there to play good, solid defense for you. And gold has been doing that so far this year. Hasn't gone down nearly as much as the general markets has. But anyways, he said, look, the dollar can go up versus other currencies. So we can have a strengthening dollar still going into 2023, but we could have it falling versus gold, right? So, historically, we've kind of had this inverse relationship between dollar strength and the price of gold. But it doesn't have to be that way. And I was looking for Brent to reaffirm that, which he did in this recent interview, which is, the dollar can strengthen and gold can go up versus the dollar together. And in fact, Brent expects that to happen, which is why he's got a good chunk of his portfolio in gold. I think he said something about 25% or so. So, for folks that are maybe despairing the strength of the US dollar right now, don't give up your precious metals based upon that alone, because the guy who's actually at the head of the group predicting a stronger US dollar internationally is telling you to still stay in gold. So I thought that was a really important thing to keep in mind. The last thing I'll say on this, and I'll just give you a chance to respond, Mike, but is, you and I over the years, we've seen lots and lots of people who, for very valid reasons, say, look, the fiat currencies, their days are numbered, right? All of these currencies have big issues. They're all getting inflated away. Their purchasing power is getting inflated away. And therefore, you want to own real assets that are going to appreciate in value on a relative basis to these currencies. And there's a lot of people in America that feel that way about the dollar. And they can make extreme decisions based on that. I'm sure you get the same comments I get every so often about, oh my God, the dollar's going to zero tomorrow. Why would you want to be in cash, right? And I think Brent did a really good job of saying, look, that may be true in the long arc of history here. But he talked about how, reserve currencies, their lifetimes usually measured in centuries. And there's nothing right now on the international monetary chessboard that looks ready to replace the dollar, certainly in the next decade, probably decades from now. Nobody knows for sure, but it's not likely that we're going to wake up tomorrow and hear that the dollar has failed, right? So, cash is still a wise place to park capital right now if you're looking for safety. And the dollar will likely be the last domino to fail, as measured versus the current major world fiat currencies. So we're highly likely going to see the whole dollar milkshake theory, capital flooding into the dollar, capital finding safety here in the US. Whether that's fair or not, that's just, Brent said, that's just the game that's being played right now. And you want to be careful that you don't let your principles force you to take a position that could get you steamrolled, just because of the way that the game is played right now, right? Probably beating this horse bloody here, but end of the day, Mike, you're a capital manager. I know you don't love the dollar, as a currency. I know you don't love a lot of what's going on with U.S. monetary policy or whatnot. But your job is to make sure that people have the same or more money tomorrow than they do today. And so, to a certain extent, like the game or not, you have to play it by the rules that it's currently run by. So, love to get into your reaction to that.
Yeah, well, it's true. I don't love the policies that we have here, the monetary policies. Let's put it that way. I'm not talking politically. I don't like the constant central bank intervention. I don't like the Fed put. I don't like the absence of free markets. I don't like the absence of price discovery. But the truth is, we do have the world's reserve currency, and frankly, we've really leaned on that for a long time, more than we really want to admit. We've leaned on that. We've abused it to some extent, and we even bully with it a little bit. And so far, we're getting away with it. I don't think we're going to get away with it forever. But I agree with Brent that it's probably going to last longer than we think. I think he said that he doesn't really see the world's reserve currency coming off the dollar, at least for, I think he said both 5 years and then also for the remainder of the decade, which is 8 years. He might be right, particularly when you realize, we're not going to lose the world's reserve currency unless we either lose a war or B, introduce a central bank digital currency that the whole world agrees on. So in that second piece, the central bank digital currency is certainly not going to come before a crisis comes. We would have to have an awful economic crisis for that to even be politically feasible. So none of it's good news, and nobody wants to hear bad news, but it is the truth. We have put ourselves into a corner here by allowing central banking to get as pervasive as it has, that it's going to be really hard to get out of. He talked about a few things that I thought were really useful to users to really understand some of these concepts more simply. He said, hyperinflation. We haven't had hyperinflation. Don't worry about hyperinflation yet. I kind of agree with him. I think that the deflationary pressures or an asset price crash is more likely in the near term. He says you get hyperinflation when you print money with no external demand, like I think he said Zimbabwe or Venezuela or any one of those other examples. The United States, we print money like crazy, but it's just sucked up around the world, the whole pebble and the boulder thing, and it just absorbs more and more and more. And he said the Fed, don't think the Fed is going to pivot very quickly. They're going to hike and hike and hike until they can't hike anymore. And why would they stop hiking when stocks are up? They're up, almost 15% off the lows of a few weeks ago. Volatility is down. They need to get some currencies so they can try to rescue the market next time it tumbles, which is, I think, why he thinks that we're going to have some weakness, or one of the reasons he thinks we're going to have some equity weakness over the next 6 months. And I completely agree. I know I'm rambling in different areas here, but just a couple more things that I'd like to talk about. He says that, well, let me actually slow down there for a second. He said that if he talked about emerging market debt, I thought that was interesting. There's a huge amount of sovereign debt worldwide that's denominated in dollars because all these countries did business with us. We have the relative safety or the safe place to park money. And so a real problem would be a sovereign debt crisis. And that happens if we actually have a dramatic increase in the US dollar, which is actually possible as capital flees into the dollar. And, he said that could very well cause a sovereign debt crisis. And far from thinking that would finally teach them their lesson, well, they finally burned their hands on the hot stove. Well, there would be some kind of fix or stopgap, and then they would just double down on those policies again. So it's a little bit disheartening to realize we're the only way out of some kind of crash or economic malaise is for the $300 trillion global debt bubble to continue to increase ever more. If you take your foot off the gas, kind of the whole machine stops working. And this is kind of what we're warning people about. We're at a point of the most excessive valuations by far, really in US history, at a time where the system is so complex and intertwined, where there is no plan B. And the only answer is to print more and more and more. I mean, it sounds like a simple concept that we should be careful about that, but so far, everyone's just going along for the ride while it's working, and we don't think it's going to work too much longer.
All right. Well, I think that's one reason why a lot of people enjoy talking to you guys, Mike, is you guys aren't just sort of faith-based capital managers the way that a lot of just, big brand stockbrokers are these days. You actually wrestle with a lot of the same macro concepts that all of our guests like Brent, really spend their time focusing on here. You mentioned one thing that I just wanted to get your thoughts on, because again, you guys are managing capital here and you're having to determine how much to be in the market right now versus how much to be out of it. And we're having, a pretty substantial bounce in the markets. The June lows were like around S&P 3,600 or something like that.
36, 36.
Okay, 36, and we're up in the kind of like 4150 range right now or so.
4165, yeah.
Okay, good, 4165.
Plus 14.5%. Yeah.
Remembering pretty well. All right, yeah, 14 points. So that's a big bounce in just a little bit over a month. And it seems like, it's not that the earnings reports that have come out are fantastic. We're not seeing we're not seeing upward revisions going forward. We're still seeing a lot of downward revisions going forward. So it seems what's driving a lot of this is that either things aren't as bad as people were fearing a few months ago, and that even though the earnings results the forecasts are coming down, they're not coming down as much as people thought. And or it's because people are thinking, okay, we're getting close to the Fed pivot moment here, and the Fed's going to have to step in. And of course, we saw a pretty big jump after last week's Fed announcement, where they announced that they were going to be data dependent going forward and not providing as clear of a roadmap. And people took that as it's dovish news to say, oh, well, the Fed is now, basically kind of saying they're not committing to as many future rate hikes as they've been so far, right? But to Brent's point, which was echoed by Thomas Thornton earlier this week, both of them said, hey, look, the Fed is highly likely going to have to be forced to pivot here. And if the markets are if the S&P is above 4,000, if unemployment, still remains as low as it is, if inflation is still hanging out where it is right now, none of these give the Fed a reason to pivot. And in fact, the higher the market goes, the more air cover the Fed has to continue hiking rates. And the Fed wants to be hiking rates here because it knows the system is unstable. And so it wants to have, as much wiggle room as possible to drop things again, to drop rates again when the next big recession, hits in full force. And so, it's almost sort of like the people that are getting really excited about a pivot right now and jumping into the market are actually diminishing the odds of that actually happening, and therefore increasing their odds of being disappointed and probably having the market do a rug pull moment on them, which we think, or correct me if you disagree, but we've talked about this the past bunch of weeks. we think that would be completely in keeping with a standard bear market, right? Which is you have the long secular market, but it's got these secular, pretty substantial rallies here in it, and they basically serve to sucker the bulls that were on the sidelines back in before the bear market rolls over and starts going down further. So do you think that that's sort of what we are seeing going on here? Or I know I'm asking you to speculate, but do you think that is more likely here than the scenario of, oh, nope, the Fed pivots in a couple of weeks and then, happy days are here again and the market's, the bull market's back on?
Yeah, I'm happy to speculate, Adam, or at least try. It doesn't mean I'll be right, because I don't know the future any more than anybody else. But I'm looking at an S&P chart here. It's been a pretty straight up rally for about 6 weeks. We still think that this is a bear market rally. We've retraced maybe almost half, not quite. If we get up around 4,300 or so, we retraced about half of the entire decline, maybe a little under 43, but we're closing in on about a half, 50% retracement. It's a very substantial retracement, and I'm surprised, frankly, how it turned on a dime about 6-7 weeks ago and has been up ever since. Yes, absolutely. The success in the market makes it even more likely that the Fed is not going to ease. Think about it. If you were in their shoes and you realized just how strained the system was, how many variables there are that they can't control, you would want to get interest rates up as high as possible so that you can have more ammunition, more ability to move that lever back towards accommodative. But that's only going to come after a much deeper market retracement. So we barely ended up down almost over 20% in the S&P at the lows. The guest last week or the week before, I can't remember which, said, look, this is probably not going to be your garden variety bear market. This is, we're coming off of super bubble valuations. We're very, very late in the cycle. We've got an inverted yield curve. We're almost certainly in a recession by the textbook definition. It's almost like nothing matters anymore. The market just bounces on a dime and everyone's dying to get in. The bubble that everyone can see that really nobody wants to do anything about. I can tell you, we've been talking to people. I've been talking to people this week that aren't clients yet, that are just feeling really conflicted about what to do next. A lot of times they feel like they're overexposed. They might be in the typical 60-40 or 70-30 or 80-20 portfolio. They're getting a great gift here. The S&P topped out at 4,800. We went down to 3,600, and here I am looking at it. We're almost at 4,200. Again, almost a 50% bounce back into that decline. What a wonderful opportunity to move yourself to a more conservative position. I'm not saying sell everything, but decide right now what type of investor you are and what your allocation should be. If you're a passive investor, that's fine. But move your allocation passively to something that's probably going to withstand the coming bear market better. Maybe move from 70-30 down to maybe 30 or 40% stock. Sorry, that's my closing bell ringing, 4 o'clock Eastern. And then just, stick with that. But by and large, take advantage of this strength, sell into it. Brent said the same thing, that he would be selling into rallies here and just raising cash to get to a more defensive position.
And sorry to interrupt. I think maybe like the past 5 or 6 interviews that I've had on this channel, I think every one of those experts has said the same thing, which is use rallies as a chance to sell right now. So, everybody needs to make their own decision. And obviously, as we say in this channel, do that in partnership with your own financial advisor. But if you're going to take that advice, this seems like a really opportune moment to take it.
Yeah, absolutely. I would do it. And we're happy to chat with anybody if they want to have, another set of eyes, on their situation. We don't, never a sales pitch with us. We're just happy to chat. We give free advice all the time. So
great. Well, as a reminder for folks, if you're interested in taking Mike up on that, just stick around at the end of the video. It's coming up in just a couple minutes. We tell you how to set up one of those free consultations with Wealthion's endorsed financial advisors, which includes Mike and his firm. And again, these things are free. There's no commitment to work with them. These guys just offer it as a public service because they're trying to help as many people as possible take prudent steps now before things potentially get really rocky if the bear market takes its next leg down. All right, Mike. Well, look, I've got a couple quick bits of news to share with folks here. I want to let you have the last word first, though. I know right before we turned on the camera here, you were telling me that you just had a couple really big clients that are coming on board this week. So I'm just curious, do you have any parting advice for folks here as you're talking with people of all different portfolio sizes day in and day out who are trying to make sense of what to do right now?
Oh, absolutely. We treat everybody the same, Adam. I wish that we could multiply ourselves so we could talk to even more, but it doesn't really matter the total value of your portfolio. What matters is kind of your viewpoint on the future, what your own psychological makeup is, your ability to weather a difficult storm, because not all times are equal in history. We're probably in the midpoint of a fourth turning. Many of your viewers will know exactly what that means. It's going to get difficult the next bunch of years. If you look at the valuations, they're crazy. That feeds into the fact we're probably reaching the zenith of all of this. Again, decide what kind of investor you are, and if you're passive, that's fine. Just slide yourself down the scale so that you can weather the storm better. Things will be okay in the long run, but it's going to be a lot smoother for you if you do that. And so we've talked to people with hundreds of millions of dollars. And honestly, the advice isn't that much different for them as it is for somebody that has even, a small account, even $5,000 or $10,000. Now we do have a certain minimum for our managed account program, but I guess the point is we treat everyone the same. We try to anyway. And no matter how much money you have, really, you have to do the best with what you've got and make sure that you feel comfortable going through it. Okay.
All right. Well, very well said, Mike. Okay. So folks, in wrapping up, a couple of great resources for you. One is we're continuing our Cliff Notes of the key takeaways from these interviews that we're doing. We just started this last week. The reception's been incredibly positive so far, so we're going to keep it going. If you want to see my write-up of my key takeaways from the interview that we just did with Brent, just go to wealthion.com/AdamsNotes. You can read them there for free. And if folks continue liking this, I'll keep doing it going forward. And that way you can just lean back and really enjoy the conversations and you don't have to take furious notes. All right. Secondly, big news. Wealthion is having its second ever fall conference. We did one at the end of last year, which turned out to be incredibly valuable for folks because we had our, guest faculty come and talk all about how things were very likely to change with the end of stimulus, both monetary and fiscal ending, and the fast rise that we were seeing in inflation, and how that was likely going to create a massive secular shift in the markets. And boy, oh boy, did it ever. And the folks that took that advice back at the end of last year fared 2022 so far much better than the folks that didn't come to the conference. So this year, we are doing another fall conference, even better faculty, if that can be believed. It is going to be on Saturday, September 24th. And I will tell you guys in about a week or so how you can sign up for that, unless you're an alumni of last year's event. And if so, you should have an email in your inbox right now from us with a link for letting you be one of the first to sign up for this conference and giving you the deepest discount. You're going to get a 43% discount. On Sunday, August 14th, we'll then open it up to the general public. And at that point, folks, will be offering the early bird discount price. It's going to be an almost 30% discount. And if you're not an alumnus, hop on the early bird price when it opens. Real quick, though, just to let you know who's going to be there, we're going to have we'll have Lacey Hunt as a keynote speaker. We'll have Matt Taibbi, the award-winning independent journalist of Vampire Squid fame. We're going to have Lynn Alden giving her outlook on the markets. We're going to have Brent Williams and Stephanie Pomboy. We're going to have Alf Peccatiello talking about the bond market. We're going to have Brent Johnson talking more about what he expects happening next year with the dollar. We'll have Doomberg. We'll have Rick Rule talking about hard assets. Doomberg obviously will be talking about what's going on with the global energy crisis and energy markets. We're going to have Mike Maloney and Jeff Clark talking about precious metals. And the mining stocks, we're going to have Nick Gurley talking about the real estate market. Folks, it's just going to be an all-star powerhouse, really an event not to be mixed. And we're going to have a lot more interactive Q&A with these folks as well. So they'll be giving presentations, but then also you'll have the chance to ask them questions live and to pick their brains yourself. So it should be a phenomenal time. So keep your ears peeled, like I said, on if you're not an alumnus, and don't already have that email in your inbox, then watch out on this channel. I'll let you know that Sunday, August 14th is when that early bird ticket's going to be available for that conference. All right, and then last, folks, if you enjoy seeing great minds like Brent on this channel, would like to see both him back and other great speakers like him, do us a favor and just help support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Mike, we're wrapping up another week. Thanks so much for taking the time to come on here and make sense of things for folks. As always, a great discussion, and whatever the markets do between now and next week, we'll be deconstructing it here for folks just a week from now. Thanks so much for joining, Mike, and everybody else. Thanks so much for watching.
Enjoyed it as usual, Adam. Thanks for doing it. We'll see you soon.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to Wealthion.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.